Now, again, a very important thing which you need to discuss in the IFRS 15, which comes under the head of the consideration, uh, determining the transaction price. Remember, we are dealing with determining the transaction price and the fixed consideration, variable consideration, financing component. These all are the components of the transaction price. Consideration payable to a customer. This is very common nowadays. Now let's take multiple examples. First of all, to get the concept of why we will be paying to the customers, why a vendor or a supplier will be paying to the customer. Consideration payable to a customer. Now there are multiple scenarios which can give rise to this thing. The first thing is, like, you see superstore nowadays, the superstore like Tesco, Super Walmart, these type of superstores, big superstores, the Walmart, things like that. So you go there and you see that when you see the ales, these ales are sometimes designated and only the specific company's products are there. For example, you go in the Tesco and you see that there are only products, of, for example, Pepsi's there. So they are the drinks, beverages, they're the Lays, there's mineral water, and everything is over there. Or for example, you talk about any cosmetic company, you go in the specific aisle, all the cosmetic products are there. Or for example, there's a range of perfumes over there, a company's complete perfume range is over there. Or for example, there's a bakery product, a company's complete bakery range is available over there. So nowadays, when you want to sell your product in the superstore and you want to be sold at a specific or designated aisle or designated place, then you have to pay the rent, you have to pay the rental, you have to pay for that aisles to the superstore. Do you know they are doing a very big business? All you need to do just to open up a superstore, and the companies will be approaching themselves and they will be even paying you for selling their products. So that is why you see that these superstores are earning too much, because the companies are, selling them their products, and in order to sell their products, they are paying them. Even they're paying them for the advertisements which is within the superstore. They're paying for the ales and all the things. So this is the first case of the consideration payable to a customer. Like, this is first example. If the company is selling to the superstore and they want their products to be sold in a specific aisle or a designated place, they will be paying the superstore for that. First example. Another example I gave you was the cashbacks. Nowadays you see it. Like, for example, they say if you buy our product, we'll be returning you this much amount. Now, first of all, you have to buy their product, you pay them the complete amount, and once you have paid the full amount, they give you the amount. Similarly, you have seen the coupons. Similarly, you have seen the vouchers. Like, for example, you're buying the chips, you're buying the snacks, and then it says like there is a gift under it. For example, you open up the pack and you see, okay, I have got $1 coupon. Then you give them and they return you $1. So consideration payable to a customer. It can be anything. It can be, for example, you're paying them for the ales. It can be cashbacks. It can be coupons. It can be vouchers. Now, anyways, it is easy to understand that the entity is paying to their customers. So how this should be recorded? Simply, this is the reduction in the selling price. Simply, this is going to be a reduction in the selling price. This is going to be a deduction in the revenue. Like, for example, if the customer is buying your product for $100 and you say if you buy our product, we'll be returning you $1, that means you should record the revenue at $99. This is simple common sense. So consideration payable to a customer is common nowadays, and consideration payable to a customer includes cash amounts that a vendor pays or expects to pay to a customer. Credits or other items such as coupons, vouchers that can be applied against the amount owed to the vendor. Alternatively, the payment may be part of all amount payable to a customer in return for the supply of goods or services. Many companies are doing this as a promotion. Like in our area, this Pepsi have such policies. I have seen them because I have dealt with them. The Pepsi company, they give the target to their customer. They say, okay, if you're going to sell this much amount of beverages or fizzy drinks in this month, we'll be paying you this amount. So they give the targets to the customers. And once they are meeting those targets, they will pay back them an amount in the form of bonuses. Now, this is ultimately a reduction in the revenue. Consideration payable to a customer is accounted for as a reduction of a transaction price, unless the payment to a customer is in exchange of distinct goods or services that the customer transferred to the vendor. Now we are talking about the same thing. Like if I'm going to buy a bottle and I get back some amount from that bottle only, that is going to be a reduction. In the case of distinct goods or services, they are going to be treated separate. A vendor might sell goods or services to a customer, at the same time purchases the goods or services from the same customer. If the amount of consideration payable to the customer exceeds the fair value of distinct goods or services the vendor receives in exchange, the difference is accounted for the reduction in the vendor sale transaction price. This is something happening nowadays as well. For I told you in the last slide, my father is doing the business with some customers, and we are buying from those customers as well. So ultimately, we'll be doing the net off thing. Sometimes we will be paying them, sometimes they will be paying us. So that will be a consideration payable to a customer as well. If a vendor cannot reasonably estimate the fair value of the good or service, then the full amount of consideration payable to a customer is deducted from the vendor's own transaction price. If the consideration is paid to a customer in exchange for distinct goods or service, then it should be accounted for as a purchase transaction. Like if you are not talking about the same good, then it is going to be a separate purchase transaction. Let's do an example and then you get it quickly. Example. A vendor manufacturer retail goods enters into a contract to sell goods to a customer, a large supermarket group, for the period of 1 year. The customer is required to purchase at least 20 million of goods during the year. This is the target. The contract requires the customer to make changes to the shelving and display cabinets, aisles, at the stores from which the retail good will be sold. Okay, they have to make the changes at the superstore. Like obviously branding the company and then maintaining them in a good way. On the date on which the contract is entered into, the vendor makes a non-refundable payment of $2 million to the customer to compensate for the related costs, because they have to make an arrangement for the display. So the supplier is paying them the $2 million, which is non-refundable, and they will be buying the 20 million goods throughout the year. The payment by the vendor to its customer does not result in obtaining any distinct goods or service, because obviously they are not identifying any. This is because although the shelving and display cabinets will be used by the customer to sell the retail goods, the vendor does not obtain control of any rights to the shelves or displays. Still, that will be the property of the customer, because that is non-refundable and the entity will not be having any control on that. Consequently, the 2 million payment is accounted for as a 10% reduction in the transaction price, because 2 million is the 10% of 20 million. 2 divided by 20 is actually the 10%. To achieve this, the 2 million payment is recorded as an asset and is amortized as related sale of retail goods are recorded. This is very important thing you need to understand, because this question has been tested in the SPR exam and even in the P2 exam. So now every time when they are buying the goods, you're going to decrease your revenue by 10%, because they will be buying the goods of 20 million worth throughout the year. Sometimes they will be buying 2 million, sometimes they will be buying 4 million. So every time you have to deduct 10% from it, and then you will be recording the revenue. This is the first thing you need to understand. Now we have already made them the 2 million amount. We have already made them the 2 million amount. So we cannot record this thing directly as an expense because ultimately this is going to be a reduction in the selling price. What we're going to do is with this 2 million, we got a right. We got a right that they will be actually displaying our goods, they will be selling our goods in a particular way. So the treatment is that initially you will record this 2 million as an asset because you have made the payment in advance and yet you have to get the benefit of that. And this then will be amortized accordingly. Let's do another example and then you will definitely get the concept. Golden Gate enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million of products over the next 12 months, again 20 million. The terms of the contract require Golden Gate to make a payment of 1 million to compensate the customer for changes that it will need to make in its retail stores. Again, we are making 1 million payment. 1 million and the total is 20 million. By 31st December 2001, Golden Gate has transferred products with a sales value of 4 million. So yet they have made the sales of 4 million. How the revenue should be recognized. Now, first of all, you need to see that this 1 million is how much percentage of the total sales? It is 5%. Now, every time when we are making the sales, we'll be reducing the revenue by 5%. So how much sales they have made? 4 million. So we'll be recording 3.8 million of the sale. This is something that you need to understand. Now we are moving toward the step 4. The step number 1 was identifying the contract, which we discussed in detail. The step number 2 was identifying the different performance obligation, distinct goods and service. We did many examples for it. Then the third step was the transaction price, and we discussed fixed consideration, variable consideration, financing component, non-cash consideration, consideration payable to our customers. And now we are moving toward the step 4, which is allocating the transaction price to different performance obligation. Now that means step number 2 and 3 will be mixed up when you are talking about the step number 4. How? In the step number 2, what you did, you identified different performance obligations. Different performance obligations. In the step number 3, you determine the transaction price. Now what you're going to do is basically you will be allocating this transaction price to different performance obligation. That means you're actually dealing with the step number 2 and 3 in the step number 4. So what is the general principle? The general principle is that the transaction price will be allocated to different performance obligations based on the standalone prices. Standalone prices mean, for example, we are buying a car and they will be giving us the services and then they will be giving us the warranty. Let's take car and services. What if they only sell the car? What is the price of that car? What if they only provide the service to the person who has not bought the car? What is the value of the services? What is the price of the car when you buy it in the warranty? What is the price of the car when there is no warranty? So that means you have to look at the transaction price. You have to allocate the transaction price based on the standalone prices. So the best evidence of standalone price is the observable price. Like you see and go to see your price list. At what amount you are selling just the car, at what amount you are just selling the phones, at what amount you are just selling the internet. Go and see your selling prices, and you will get to know your standalone prices. If the standalone prices is not directly observable, then it must be estimated. Now, if the standalone prices is not available, then you need to estimate it. Now, again, whenever you are talking about the estimate, this should be the best estimate. Whenever you are talking about the estimate, this should be the best estimate. Now, there are three approaches when you are dealing with the estimates. The first one is the adjusted market assessment. Now, adjusted market assessment means simply at what price. Remember, we are talking about that the observable prices are not available and we are estimating. So the first approach in estimating the standalone prices, at what price competitors are selling. If you do not have the standalone selling price, okay, it's fine. We can see at what price the things are available in the market. We'll get to know the standalone price. The second thing is, okay, if there is no observable price, we cannot do it from the market, then the second method will be expected cost plus margin. What is the cost of this product, and normally what margins do you have? That will give you the selling price. If you add the cost plus margin, it gives you the selling price. This is going to be the estimated selling price, standalone selling price. This is the second way. First one was looking at the market, at what price the competitors are selling, at what price customers are buying in the market. The second method is cost plus margins. The third method is the residual. Now the residual means that you, for example, you have product A, you have product B and C. There is standalone price of A available, there is standalone price of B available, but C is not available. So what you're gonna do, you calculate the A, you calculate the B, and you take C as the remainder. That is the residual. Because you are looking at the three prices, two are available and the third one is not available. So you, what you're gonna do is take the C as the residual, as the remainder. And one of the most important point in the step number 4, other than the standalone price, is that if you are selling in a bundle, like when you talk about the bundle, there is product A, product B, service C, whatever. And the standalone prices are different than the bundle price. Usually, when the company is selling in the bundle, they give the discount. If you are giving the discount, that discount will be applied on all the components in the bundle. If you're giving a discount, that discount percentage will be applied to all of the components in the bundle. Now, obviously, we have to do the example, and then we'll be able to grip the concept. A vendor sells 3 products, A, B, and C, fine, to a customer for $100. This is the bundle price. Each product will be transferred to the customer at a different time. Product A is regularly sold for 50. That means now you see the standalone prices. The standalone price of product A is $50. Okay. Product B and C are not sold separately, and their estimated standalone prices are 25 and 75. Okay, fine. So if they sell B, it's 25. If they sell C, it's 75. Now, what is the total standalone price of these 3 products? Is 150. It's 150. and they are selling this thing in 100. That means they are giving the discount. They are giving the discount of 50. Now, whenever we are distributing this 100, now we have to distribute this 100 to A, B, and C. So when we are distributing this, we have to make sure that we are actually taking the discount into consideration. So when you're talking about A, 50 is the standalone price, and usually 150 is the standalone price of 3. It gives the discount. When you're talking about the B, 25 is the standalone price, and you divide by 150, which is the total selling price, standalone. 75 divide by 150, and then you multiply it by 100, and then 100, and then 100. So you get the results. So the total is 100. How are we going to split it? A 33, B 17, and C 50. You see, what was the standalone price of A? It was 50. What was the standalone price of B? It was 25. What was the standalone price of C? It was 75. So it makes 150. But obviously you are selling this bundle in 100. So how are you going to split it? You have to split it based on the standalone price, but you have to make sure when you are giving a discount, that discount will be applied to all the components in the bundle. Next example. Shred sells a machine of 1 year's free technical support for 100,000. The sale of the machine and the provision of the technical support have been identified as a separate performance obligation. So Shred is selling a machine and 1 year free technical support for 100,000. So it has two components, machine and installation. So machine and installation. So it's a technical support. It's a technical support, machine and the technical support. All right, machine and the technical support. The sale of the machine and the provision of the technical support have been identified as a separate performance obligation. Shred usually sells the machine for 95,000. All right, so the standalone price is 95,000. All right, it's fine. Okay, but it has not yet started selling the technical support for this machine as a standalone. Other support services offered by the Shred attract a markup of 50%. It is estimated that the technical support will cost Shred of 20,000. Now that means, first of all, you need to see the total standalone price, and then you will be comparing it with 100,000. So the standalone price of the machine is 95,000 as we just discussed, but obviously the standalone price of the technical support is not available. So now we have methods again. We are having the adjusted market assessment, we are having the expected cost plus margin, and we have the residual method. What is the price of these technical support in the market? What is the cost of technical support plus add your margins in it, and then the residual. Now, if you take the residual thing, the total price on which you are selling is 100,000. If you deduct 95,000 of the standalone price, then the remainder is 5,000. So based on the residual, you will be having 5,000, which is the price of the technical support. Now the second method is actually the cost plus margins. Cost plus margins. Now that means 20,000 is the cost plus 50% is the margin, which makes 10,000, 50%. That means 30,000 will be the price of the technical support. So 95,000 is the price of the machine, 30,000 is the price of the technical support. What is the total? The total is 1,25,000. Now the total standalone prices are 1,25,000, but you are giving this thing in 100,000. That means you are giving the discount. Now, how much discount is being given? It is 20%. How you calculated it? 25,000 is the discount amount divided by total 1,25,000. It gives you 20%. So simply what you're gonna do, you can make the same calculation which we did last time. What you're gonna do is the first way is 95,000 multiplied by 80%, or you just say 95,000 divide by 1,25,000 into what was the price? 100,000. So this is how you're going to calculate it. Similarly, you will be taking 30,000 divide by 1,25,000 multiply by 100,000. So you will record the 76,000 for the machine and 24,000 for the technical support, and the collective amount is 100,000. So this is how you are